Why banks love customers who carry credit card debt. The most profitable credit card customer is not the reckless spender people love to mock. It's not the person drowning in chaos, missing every payment, phone vibrating with collections calls. And it's not the disciplined person who pays the balance in full every month, collects the points, and walks away clean. The customer banks love most lives in the middle. They look responsible. They keep the account open. They use the card often. They make the payment. Usually on time. Maybe even every time. But they never quite get out. That's the shocking part. Because the system was never built around helping you borrow for a moment and move on. It was built around turning temporary need into recurring revenue. Not through force. Through design. And once you see that, the whole thing changes. Most people think credit card debt is a personal failure with a plastic card attached. Bad habits. Weak discipline. Overspending. Lack of self-control. That's the public story. It's simple, moral, emotionally satisfying. It gives everyone a villain. But simple stories are useful when you need people to stop asking better questions. The deeper truth is colder. Banks do not merely tolerate credit card debt. They organize around it. They plan for it. They price for it. They market around it. They build products that are elegant when used one way, but astonishingly profitable when used another. And the difference between those two ways is often just one difficult month. That's what makes the system so effective. It doesn't need you to collapse. It just needs you to wobble. A car repair. A medical bill. A rent increase. A slow season at work. A family emergency. A few expensive weekends when life felt heavy and you wanted relief. One bad quarter in a good life. That's all it takes. Because credit cards are sold as flexibility. Freedom in your pocket. Convenience with rewards. A smoother life. And on the surface, that part is real. Swipe now, deal with it later. No awkward delay, no immediate pain, no visible subtraction from your bank account in that moment. The transaction is frictionless by design. But what matters is not the swipe. What matters is what happens after the swipe, when a short-term solution quietly becomes a long-term structure. That structure has an unusual genius to it. It doesn't ask for the whole balance. In fact, it specifically does not ask for the whole balance. It asks for the minimum. A small, survivable number. A payment low enough to feel manageable, reasonable, adult. And that minimum payment does something psychologically brilliant. It allows you to remain a good person inside a bad system. You're not ignoring the debt. You're handling it. You're making the payment. You're being responsible. The balance may not really be shrinking in any meaningful way, but emotionally, you still get to feel compliant. Still inside the lines. Still one of the people who pays their bills. That feeling is worth a lot. And the system knows it. Because once a debt feels morally managed, it stops feeling urgent. Now the balance can sit there. Quietly. Month after month. Accruing interest. Generating fee opportunities. Extending its life. Becoming part of the landscape of your finances rather than a problem demanding immediate escape. That's where the real business begins. People often imagine banks make money when you do something dramatic. When you fail spectacularly. When you go delinquent or get crushed by penalties. But that's messy. That's expensive. That's risk. The ideal customer isn't the one who explodes. It's the one who absorbs. The one who carries a balance for years, keeps paying, keeps swiping, and keeps believing they're one strong month away from clearing it all out. Banks make money from interest. They make money from fees. They make money from the small cut attached to every card transaction. But those streams become especially beautiful when combined in one person, someone who uses the card constantly and revolves a balance anyway. That customer is not a glitch in the system. That customer is the system working perfectly. Think about the message wrapped around most credit cards. It's never, this is a very expensive emergency loan disguised as convenience. It's travel points. Cashback. Status tiers. Fraud protection. Airport lounges. Sleek metal cards. Better experiences. Smarter spending. Exclusive access. The product is wrapped in aspiration. That's important, because aspiration is softer than warning labels. It bypasses defense. Nobody feels trapped when they are being invited into a more elevated version of themselves. You're not reaching for debt. You're reaching for flexibility. Rewards. Sophistication. A little breathing room. The card doesn't present itself as a liability. It presents itself as a lifestyle interface. And that presentation matters more than people realize, Because humans don't respond to financial products as spreadsheets. We respond to them as emotional objects. A debit card says, "This is your money leaving." A credit card says, "This is a decision your future self can absorb." That difference is massive. When the pain of paying is delayed, behavior changes. Spending changes. Limits change. The sense of consequence blurs. That's not a character flaw. It's human wiring meeting institutional design. And then the really subtle part begins. Once you have a balance, the card starts changing your financial life in two directions at once. On one side, it gives you relief. It lets you keep functioning. You can still buy groceries, cover the gap, get through the month, say yes when you otherwise would have had to say no. That creates gratitude, dependency, even loyalty. On the other side, it quietly weakens your future cash flow. Interest drains money from the next month before that month even begins. So now next month is tighter. Which makes the card more useful again. Which makes the balance harder to kill. Which makes the minimum payment feel even more attractive. That loop is the hidden mechanism. People think they are using the card to survive a shortage. But the card can become the thing that helps preserve the shortage. Not because every borrower is irresponsible. Not because every bank executive is sitting in a dark room plotting against households. The truth is more ordinary and more unsettling than that. Incentive systems don't need villains. They just need alignment. If a product becomes more profitable when customers remain in a state of low-grade financial strain, then the institution has a structural incentive to keep that strain functional, not fatal. That distinction matters. Fatal strain creates defaults, charge-offs, regulatory scrutiny, public anger. Functional strain creates revenue. So the system does not want you dead. It wants you durable. That's why the product feels so survivable while being so draining. That's why the statements look manageable while the balance barely moves. That's why the language is full of empowerment while the math runs in the opposite direction. That's why the trap doesn't feel like a trap until you've lived inside it long enough to mistake it for normal. And once it becomes normal, something even more powerful happens. Your standards adjust. The balance that once terrified you becomes not ideal, but under control. The interest charge that would have offended you 2 years ago becomes part of the monthly weather. The fact that you need next paycheck before you can breathe becomes routine. You stop asking, "Why is this happening?" You start saying, "This is just adulthood." That sentence has probably protected this industry more than any legal team ever could. Because when people internalize a structural problem as a personal weakness or an inevitable part of modern life, resistance collapses. Shame takes over. And shame is incredibly useful to systems that don't want scrutiny. If you feel embarrassed about your debt, you are less likely to examine the architecture of the product. If you think your balance is proof that you are bad with money, you are less likely to notice how precisely the product was built to be easy to enter and slow to exit. If you keep the entire story inside your own character, the institution disappears from view. That is one of the most elegant tricks in modern finance. The more personal the pain feels, the less systemic it looks. And credit card debt is a masterclass in that conversion. Because it meets people at their most human. During transition. During instability. During ambition. During loneliness. During the little humiliations nobody posts about. It's there when your paycheck is late, when your kid needs shoes, when your friends book the trip, when your car won't start, when you're trying to keep your image intact, when you're trying not to feel poor, when you're trying not to say, "I can't." The card steps in like a loyal friend. Then it sends the bill in the language of contracts. And here's the especially brutal part, even people who understand all this can still get caught. Because knowledge is not the same thing as margin. A financially literate person without enough room is still vulnerable. A smart person under stress still discounts the future. A careful person who has too many fixed expenses and one badly timed emergency can still become exactly the kind of customer the system loves. That's why the smug version of this conversation is so useless. The one where people act like debt only happens to the foolish. That story is comforting to people who need to believe they are immune. But the credit card industry doesn't survive on foolishness alone. It survives on ordinary instabilities scaled across millions of lives. It survives on the fact that modern life is expensive, uneven, and socially performative. You are expected to look stable before you actually are. Expected to keep up before you've caught up. Expected to absorb shocks privately. Expected to maintain competence at all times. Credit cards fit perfectly into that world because they let appearances survive longer than cash flow does. You can still look okay. Still function. Still participate. Still postpone the visible collapse. And institutions love products that convert hidden stress into monetizable behavior. That is the real reason banks love credit card debt. Not because debt is dramatic.
Because debt is quiet.
It doesn't break the customer immediately. It harvests them slowly. It doesn't announce itself as a crisis. It embeds itself as a condition. It doesn't need the borrower to lose hope. It just needs them to stay busy, tired, and slightly behind. That customer will keep paying.
Keep borrowing. Keep normalizing. Keep carrying.
And because they are still technically managing, the machine can keep calling it choice. Look closely at how elegant that is. The same product can be marketed as freedom, experienced as relief, judged as personal responsibility, and monetized as long-term dependence. Very few systems are that efficient. And to be fair, credit cards are not pure evil. That's too childish a frame for something this sophisticated. Used carefully, they can be useful. Sometimes deeply useful. They can bridge timing gaps, protect purchases, simplify transactions, provide genuine short-term flexibility. The issue is not that the tool has one purpose. The issue is that the institution profits most from one specific pattern of use, and that pattern is both common and psychologically easy to fall into. That should change how we interpret the entire landscape. When banks advertise rewards, convenience, and empowerment, they are not necessarily lying. But they are highlighting the pleasant surface of a product whose economic engine often runs elsewhere.
The shiny part gets attention.
The sticky part gets revenue. And once you understand that, a lot of cultural noise starts to sound different. The obsession with financial discipline. The constant moral pressure around budgeting. The way debt conversations get individualized instantly. The way people are told to feel guilty before they're told to look at incentives. The way be responsible gets repeated more often than ask who benefits. Responsibility matters.
Of course it does.
But responsibility without system awareness is just self-blame with spreadsheets. And if you really want to understand why credit card debt is so persistent, why so many people remain trapped in balances they genuinely want to escape, why the product keeps expanding while households feel increasingly squeezed, you have to stop seeing the debt as merely a bad outcome. You have to see it as a stable output. A recurring balance is not always a sign the system failed. Sometimes it's a sign the system achieved exactly what it was built to achieve. That's the disturbing reframe. Because it means the pain isn't just accidental fallout from a useful tool. In many cases, the pain is woven into the business.
Logic. Not maximum pain. Not total ruin.
Just enough pressure to keep the revenue alive. Enough to make the card necessary. Not enough to make the borrower disappear. And once you see that, the emotional tone shifts. The question is no longer, why are people so bad with credit cards? The question becomes, why are we surrounded by products that become more profitable when people can't quite get free? That's a much more dangerous question. Because it doesn't stop at banks. It points at a larger pattern in modern life. Systems that don't need your destruction, only your dependence. Systems that work best when you are functional, anxious, productive, and unfinished. Systems that sell convenience up front and collect leverage in the background. Credit card debt is just one of the clearest examples because the monthly statement makes the relationship visible, if only for a moment.
A number. A minimum. A due date. A quiet little choice.
And behind that choice, an entire architecture of incentives hoping you mistake survival for control. So no, the shocking reason banks love credit card debt is not simply that it makes them money.
That part is obvious.
They love it because it is one of the cleanest forms of profitable captivity ever invented.
Voluntary. Familiar. Legible.
Socially accepted. A debt that can sit in plain sight for years and still be interpreted as normal life.
It doesn't need chains.
It just needs a card in your wallet, a little pressure in your month, and a system patient enough to let the balance become part of who you think you are. And once that happens, the machine hardly has to push at all.
You push yourself. Every month. Right on time.